Hello, welcome back, friends. This is the second session of part 1 of PGBP. In this, we are going to discuss the balance part of the chargeability section, the deemed provisions. In the first session, we have discussed the chargeability section 28 in detail. In this session, the profits chargeable to PGBP, the deemed profit and the treatment is discussed. The following are deemed income under PGBP. Business income in the previous year in which such benefits are obtained. Chargeable even if the business from which they arise cease to exist prior to the year in which the liability under section 41 arises. The firm or the business organization may not be there. The business might have been ceased to exist. Even then, this section is valid. Now the 41 clause 1 refers recovery under any deduction, remission, cessation of trading liability. So you might have already got some deductions, and those allowed deductions, maybe some cases you might have got 100% deductions. So if you got 100% deduction, for example, we can the scientific research 35D, we are getting 100% deductions, and if you are getting any income for those assets for which you have claimed 100% deduction, those income are charged under PGBP. Where an allowance of deduction is allowed in any assessment year in respect of loss, expenditure, trading liability, and in any subsequent previous year, any amount received in cash or kind in respect of such loss, etc., by way of remission or cessation thereof, the amount obtained or the value of benefit accruing shall be taxable as income of that subsequent previous year, disregarding whether the said business or profession is still in existence. So that is immaterial whether that said business is in existence or not. So you have received some benefits or some amount, some deduction, some allowance. So because of that you are getting some amount. That amount, the value of the benefit you are getting in the subsequent previous year. In one previous year you have received some deduction, some allowance, and the subsequent previous year you are getting some income out of it through sales or transfer, whatever. And if you get such an income, that income is chargeable under PGBP. Deduction of any loss, expenditure, trading liability was allowed in earlier years, and during the current previous year, the assessee has obtained refund of such expenditure or some benefits in respect of such trading liability by remission, that means the reduction and cessation or stopping of something, and because of that you are getting some income of such liability. Then such refunded expenditure or remitted ceased liability shall be deemed to be the income of the assessee in the previous year in which the amount is recovered. The liability is remitted. Example is section 35D, scientific research. You will learn more about this section in the coming sections. The provisions hold good even when the business or profession for which the deduction has been made cease to exist, even though the business is not in existence present in the subsequent year. Even then, the provision holds good. The allowance or deduction must have been made previously while computing taxable income. Okay, now actually you would have already, the deduction must have done from the income in some previous year while computing the taxable income. Then only it is considered as income when you receive some amount out of such assets. Where benefit has been obtained by successor of a business, such benefit shall be taxable in the hands of the successor. Now that you have transferred your business, so you have a successor. Okay, so through amalgamation or through a demerger, merger, or by transfer, that your business has been transferred to some other person or maybe some other directors or another company. So if that is the case, if such benefit is obtained by the successor, it is taxable under the hands of the successor. Amalgamation means actually one or two companies coming together forming a new company, and the amalgamated company is the successor, and it can have many forms. Demerger means one company is split into more than one company. One company is split into multiple companies, and that asset will be transferred to one particular company. So who possesses that, or who is the owner of that asset, he may be getting that benefit out of this, and he is the successor of, as far as that asset is concerned. Recovery after discontinuance due to death or retirement of the person carrying on such business or profession. Okay, death or retirement of the person carrying on such profession, and recovery after that we are getting. Then as per section 176 3A and 4, any sum received shall be deemed to be income of the recipient and chargeable to tax in the year of receipt. Whoever is the recipient of that income, he is liable to pay tax for that. In case there is a successor, the successor will be liable to be taxed for any such benefits received by him in the subsequent previous year. Successor in business, if amalgamated, the successor will be the amalgamated company. If succeeded by another firm, the successor will be the other firm, the partnership, maybe some partnership firm is succeeded by actually another set of partners. One partner was removed, or maybe new partners are joined, then has removed the old partners. Then the successor will be the other firm, and that new firm with the new partners is the successor of the company, and they are liable for the income received. If one person is succeeded by another person, the other person will be the successor. In case of proprietary, for example, the company is transferred from father to son. In that case, the son will be the successor. In case of demerger, when one company is split into two or more companies, then the successor will be the resulting company. Means actually the company to which the asset is transferred. A demerger is when a company splits off one or more divisions to operate independently to be sold off. It is the converse of merger. Remission cessation of a trading liability includes remission cessation of liability by a unilateral act of the assessee by writing of such liability in his book of account. Now the trading liability is written off, maybe some bad debts or something. It's written off by the assessee himself unilaterally. Then the trading liability is still valid for him. Section 41-2, balancing charge chargeable to PGBP in the case of power sector undertakings. Power sector undertakings. Straight line method of depreciation to be followed by power sector undertakings. Depreciation claimed for building, plant and machinery under section 32(1)(1), sold, discarded, demolished. For the power sector undertaking, straight line method is followed. They can follow straight line method or WD method. But actually, if they want, they can change, or they can opt for SLM method also. SLM method or WDV method. This facility is only for power sector undertakings. Other undertakings will not be allowed to take SLM method for depreciation. Okay. Other companies or undertakings has to follow WDV method compulsorily. So in the case of power sector undertakings, balancing charge is when sale value is more than WDV and sale value is less than the actual cost of assets. Then the difference between sale value and WDV is the balancing charge and is chargeable to PGBP. Here we have taken, for example, that actually the sale value for scrap value we have to take, but actually scrap value I have taken 0 in this case. That's why I have not mentioned scrap value here. For example, now you take a case where sale value is 5 lakh, scrap value will be considered 0, and WDV, let us assume WDV is 4 lakhs. Okay, and the cost of asset is let us assume it is 5.5 lakhs. Now in this case the sale value is greater than the WDV, okay, and sale value is less than the actual cost of asset. Then say the difference between sale value and WDV is the balancing charge and is chargeable to PGBP. Here what it is being said is actually at the cost after after deducting the depreciation, WDV is coming. Okay, WDV is coming after deducting the depreciation. So the value that we may get for that asset is maximum we may get is WDV, but we have sold at a price more than the WDV. So the cost of asset was 5.5. From that actually 1.5 lakhs was received as depreciation during these years. Now the balance as of today is 4 lakhs. Now when we are trying to transfer the asset, we are getting a value of 5 lakh sale value. That means more than the worth of the asset, WDV. So there is a difference of sale value minus WDV is 1 lakh. That is a profit. So because you are supposed to get maximum of 4 lakh only for that asset. Above the 4 lakh WDV, whatever amount you are getting, that is a profit only. So it is a balancing charge and is chargeable to PGBP. This case is valid only in the case of power sector undertaking, which is following SLM method. Okay. When some asset or plant and machinery or power sector undertaking, which is following SLM method of depreciation, is sold, discarded or demolished, if you are getting some balancing charge, that balancing charge is chargeable to PGBP income. Now, second case, sale value is greater than the actual cost. Here, the actual cost we are considered 5.5 lakhs. Now, the sale value, the second case, what we are is actually 6 lakhs we sold it. Okay, scrap value will be 0. Actual cost we know that 5.5 lakhs. And here, sale value 6 lakh is more than the actual cost of 5.5 lakhs. So there is a difference of 0.5 lakhs, which is considered as actually short-term capital gain. So the difference between the sale value and the actual cost is short-term capital gain. And the actual cost is 5.5 lakhs. WDV we know that is 4 lakhs. Actual cost is 5.5 lakhs. And the difference between the actual cost and WDV is the balancing charge and chargeable to PGBP. And the difference between the sale value and the actual cost, the positive difference, that is charged to short-term capital gain. So up to the actual cost, it is chargeable to PGBP, and above the actual cost, whatever profit we are getting will be chargeable to capital gain, short-term capital gain. If the sale value is less than the WDV, for example, when we sold, we got only 3 lakhs. WDV, as we know, is 4 lakhs. So the sale value is less than the WDV. Then actually the difference is the terminal depreciation. Now there is actually a loss, to be frank, because actually we are supposed to get 4 lakh for that asset, but on marketing, on selling it in the market or transferring, we get only 3 lakhs. So there is a shortage of 1 lakh. This is called terminal depreciation, and to be shown as an expense in the P&L. The expense of the PGBP, this is P&L. Okay. And it should be shown in the book of accounts also as a loss. The year of taxability is the year of sale or transfer. Example, let us see an example. Like the actual cost is 5 lakhs, opening WDV is 2.5 lakhs. Now, in the SLM method, you know that how the SLM method actually depreciation is calculated. What is depreciation? Depreciation is equal to cost divided by the life of the asset. Okay. Now it is actually 5 lakhs is the cost. Okay, and 5 years in the life, it is actually 1 lakh. 1 lakh per year is the depreciation. Okay, and since it is SLM, it will be the same always. We get all 5 years 1 lakh will be charged as depreciation for 5 years, and you will get provided here actually that scrap value is 0. Okay, if there is a scrap value, then it will be the cost minus scrap value you will get, and that will be divided by the life. That will be your depreciation. Okay. Now here let us assume that the actual cost is 5 lakhs and operant WDB is 2.2 lakhs. Scrap value, let us assume 0. Then the sale value, you consider 3 cases. Case 1. Case 1, what is the case 1? Case 1, sale value is 2 lakhs. Actually the WDB is 2.2 lakhs. But sale value is only 2 lakhs. Now what happens if the sale value is less than the WDB? So the difference is 0.2 lakhs, which is the terminal depreciation, and it is a PGBP expense and charged to profit and loss account as an expense. Okay. Now under section 32(1)(3), written off in book of accounts. It should be written off in the book of accounts. Okay. WDB left after sales. Now let it be sale value be 3 lakhs. Then that means it is more than the WDB. So then the sale value minus WDB, we are getting 0.8 lakhs, which is the balancing charge and is chargeable under PGBP as an income. Okay, as per 41(2). Section 41(2), we have discussed it actually. Under 41(2) we have discussed the balancing charge. Okay, now let the value be 5.5 lakhs sale value. Then the 5.5 lakhs minus 5 lakhs is 0.5 lakhs is short-term capital gain under section 50A. Short-term capital gain is discussed in 50A. Okay. Now this is up to the cost of the asset. Now the cost of the asset minus the WDV, whatever we are getting is the balancing charge to be treated as PGBP, and then that means there is 2 parts in this. Okay, in this case there is 2 parts. One part is up to cost of asset. Second part is actually above cost of asset. Whatever we get above cost of asset is short-term capital gain, and whatever we get up to cost of asset is the balancing charge. It is charged charged under PGBP. Okay, clear. Another example we will see. Asset cost is 1 lakh, life is 10 years, it is SLM. Then depreciation, let us assume the depreciation is 10%. That means that 10% depreciation means actually 10,000 per year. Okay, depreciation 10 years. So it's 10,000 per year depreciation. Now we use for 2 years. That means actually 20,000 rupees deducted for received as depreciation. Okay, that is deducted from the cost. So WDB as per as on this previous year is actually 80,000 rupees. Okay, for 2 years 20,000 is deducted. Now it is 80,000 rupees. So the present WDB is 80,000. The previous year 24-25. Now where the sale value is less than the actual cost or equal to actual cost, up to actual cost of 1 lakh, up to 1 lakh. Okay, so it is less than. Now the sale value is only 70,000. So WDB is more than sale value. It is 80,000. So 80,000 minus the 70,000 will give 10,000 is the terminal depreciation, because actually the sale value is less than the WDB. In the case 2, sale value is more than WDB. WDB is 80,000 and sale value is 90,000. So sale value minus WDB is 10,000, which is the balancing charge under section 41(2). It is the PGBP income. So when sale value is more than actual cost, it is more than the 1 lakh. It is 1,10,000. In this case, up to 1 lakh. Okay, actual cost minus WDB. That means 1 lakh minus 80,000 is 20,000. Under section 41(2) is PGBP income. Now excess of the actual cost means more than 1 lakh. Okay, that is 1,10,000 is there, so 1,10,000 minus 1 lakh actual cost will be 10,000. It's a short term capital gain under section 50A. Okay, now let us consider one question. It is Tata Power Limited is a power generating unit, and the company has purchased one plant and machinery on 1/6/2015 for 20 lakhs, and the same was put to use on 1/12/2015. The company has opted to follow SLM method, and the rate of depreciation prescribed under the Income Tax Act is 8.4%. In this case, the depreciation amount shall be for previous year 2015-16. I mean, already it is given the depreciation from the rate is 8.4%. Therefore, the actual cost is 20 lakhs. So, for the previous year 15-16, it will be 20 lakhs and 8.4%. Since actually it is put to use on 1/12/2015. Here, one thing we should know is that put to use means actually you might have purchased it before, but the asset when actually used in the production, or maybe put to use for the production or in the business, if it is less than 180 days, then it's up to 117 days, only 50% only depreciation only we can give. Okay, only 50% only we can give. Now that means actually for the previous year 1/12/2015 means it is actually from from 1/12 mean the December, January, February, March, only 4 months. It is anyway it is less than 117 days only, so only 50% only they will get as depreciation. But it is for the first year only, for the first year of the purchase. That year only, if it is less than 180 days, they will get 50%. These things you will learn in section 32 under depreciation. Now you will learn it. Now actually I am telling you for your benefit only now, just to get to know or just to solve the problems only. I am just telling these things to you. Okay. Now the first year they get only 50% because it is not used for 180 days. Less than 180 days only it is used. That's why it is getting like that. So first year you will get 84,000. Then second year 16-17 you can use it full year. You are using it, so you are getting full depreciation. So you are getting 8.4% of 20 lakhs, 168,000. Third year also you are getting 168,000. You are getting, okay. Because since it is SLM method, no need of deducting it from the previous years. That you will do actually, but because actually for calculating the depreciation it is not required. Okay, but if it is double DV method, you have to multiply the depreciation with the double DV, not with the actual cost. But each year for finding the depreciation, we have to multiply with the actual cost only. Okay, so let us assume that now it is told that the company has opted SLM method, rate of depreciation prescribed under the Income Tax Act. The depreciation amount will be like this. For the second year it is like the first year it is 50%, second and third year 1.68 lakhs each. Let us assume that this plant and machinery has been sold on 1/11/2018. Now 1/11/2018 means actually after this 1/4/18. Okay, now up to 1/4/18 the depreciation we are calculated, and it is sold on 1/11/2018 means it is less than, okay, 1/11/2018 only it is sold. WDV of this P&M as on 1/4/2018 is, we have to add all the three together. We will, and we have to deduct it from, we have to add all these three and we have to deduct it from 20 lakhs So 168 plus 168 plus 84,000, and we deduct it from 20 lakhs. Then we will get 15 lakhs 80,000. Case 1, the plan has been sold for 9 lakhs. So we are calculating the WDV. How will we calculate WDV? As I told, 20 lakhs minus 1.68 lakhs minus 1.68 lakh minus 84,000. So what we are getting is 15 lakhs 80,000. Okay, correct. So first case, let's assume that plant has been sold for 9 lakhs. In this case, the WDV is 15 lakhs 80,000, then sale value is 9 lakhs. So difference is 6 lakh 80,000. 15.8 lakhs minus 9 lakhs is actually, because it is sold at a rate less than the WDV, then it is terminal depreciation. Case 2, sold at 18 lakhs, mean more than WDV. WDV is only 15.8 lakhs. Then the difference is 2.2 lakhs, and which is actually the balancing charge. The third case is actually plant has been sold for 23 lakhs, that means more than the cost. That means there is 4,20,000 shall be termed at the up to 20 lakhs, the balancing charge. Okay, that means actually 23 minus 20 lakhs would be treated as capital gain. Okay, 3 lakhs will be treated as capital gain, 23 minus 20 lakhs, and the 20 lakhs minus 15.58, sorry, the sale value 23. Okay, 23 lakhs sorry 20 lakhs minus 15.8 lakhs, that is 4,20,000. That will be the balancing charge, and 23 minus 20 lakhs will be the short term capital gain under section 50A. Now to calculate terminal depreciation, what we will do, calculate the return on value, WDV, or the depreciable asset on the first day of the previous year in which such as is sold, discarded, demolished or destroyed. So the first day of the previous year in which such asset is sold, discarded, demolished, destroyed, whatever, you find out the WDV. Ascertain net sale consideration if value as per 1, that the WDV is greater than the sale value, there is a loss. As per 2 means the sale value, the net sale consideration. If a value is actually the net sale means such a sale value minus the cost of sale, whatever, you will get the net sale consideration. So if the WDV is greater than the sale value, or sale value is less than the WDV, then there is a loss actually, then that is called terminal depreciation. Sale consideration is money payable to the taxpayer in respect of such depreciable asset, and plus scrap value if any. Okay, so as we discussed, the sale consideration is the money payable to the taxpayer in respect of depreciable assets or scrap value if any. Net sale consideration is actually sale consideration minus expenses on transfer. What you might have incurred some expenses for sale. That sale consideration, that expense is to be deducted from the sale consideration, and you will get the net sale consideration. That is to be considered. Sale consideration is the actual money received or receivable in cash or by check or by draft. It excludes any other thing or benefit which can be measured and converted in terms of money. If the asset is sold or discarded in the previous year in which it is first put to use, any loss on transfer of that asset shall be treated as capital loss and not as terminal depreciation. To be treated as capital loss and not as terminal depreciation. Okay. For example, you have purchased an asset in the previous year 24-25. Okay. Maybe you purchased in October. Okay. October 24. And you put to use the same asset in June 25. That means in the next previous year, subsequent previous year, you put to use. So in the same previous year, October 25, you have sold it. That means the year in which it is put to use, the same year it was discarded or transferred. If this is the case, in the same previous year, it was put to use, it was discarded, then okay, the loss you incur, maybe you have purchased it for 5 lakhs and discarded or sold for 3 lakhs, then there is a difference of 2 lakhs is there, and this, okay, and this loss, whatever loss is there, this is treated as capital loss and not as terminal depreciation. The asset must be used by the assessee for the purpose of business or profession, at least for some considerable time period during the previous year in which the transfer or sale takes place. Terminal depreciation can only be allowed if the asset is completely written off. For allowing terminal depreciation, asset should be completely written off from the book of accounts. Okay. Now, balance charged under section 41-2 and capital gain under section 50A. So just we have discussed the same thing. Okay, this is the same thing only. We are actually instead of cost, we are saying net consideration. Cost consideration we are saying. Okay, nothing else. So now let us solve one question. In this, CH Power Project is a power generating unit. On 2/4/23, it purchased a plant for 50 lakhs and eligible for depreciation at the rate of 50% on SLR. Compute the balancing charge or terminal depreciation assuming the plant is sold on 21/4/25. Okay, it is purchased on 2/4/23 and it is sold on 21/4/25. Now, how we will consider the work? Now, actually, there are 3 charges are given. They sold for 33 lakhs, 47 lakhs, 55 lakhs. 3 sale values are given. Okay. Now, ABC we are considering WDP as on 1/4/23. WDP is the same. 1/4/23 is given WDP at 15% means actually see 1/4/23 50,000 into 15%. Okay. 2/4/23 means is more than 180 days. Okay. It is actually that second day of April. Means the full year is there. Of course, it is more than 180 days, 179 days or more, or maybe 180 or more. Since it is more than 180 days, you will get the full depreciation. 15% you will get. So 2 year. 2/4/23 2. Okay, 2/4/23 you are saying the full year you are getting. Then from 1/4/24. Okay, 1/4/24 to 1/4/25. Second year. 2 years are there. So you consider the 50 lakhs into 2 into 15%. It is actually 15 lakhs. So the 50 lakhs is the 15 lakhs is depreciation, so you have to deduct it from actually the 50 lakhs minus 15 lakhs 15, then we will get 35 lakhs. The WDV is the same as on 1/4/23. WDV is the same. Is it 1/4/23 or what? No, it is not 1/4/23. Actually, it is wrong. As on 1/4/25. Okay, WDV as on 1/4/25. It is correct. 2/4/23 is the date in which it is purchased. So okay, it is actually 1/4/25. 1/4/25. The WDV is 35 lakhs. So let us assume that first case 33 lakhs. It is sold. Now it is less than the WDV. Sale value is less than WDV. That 2 lakhs is there. That is the terminal depreciation. Second case, it is 47 lakhs is more than WDV and less than the actual cost. Therefore, whatever we are getting will be the balancing charge, the difference. Now, third case, it is actually more than the sale value, more than the cost. So, up to 50 lakhs, we are taking that 50 lakhs will be the balancing charge and the balance 5 lakhs will be the short-term capital gain. Okay. Now let us go to section 41(3). Sale of assets used for scientific research related to business. The scientific research is actually explained in section 35. Okay, that we will learn in the later sessions. Okay. Now, scientific research. Both revenue and capital are 100% allowed in the case of scientific research, except land. Natural science, applied science, agriculture, animal husbandry, fisheries, social sciences, statistical research, expenditure for acquisition of rights for scientific research. Okay, all these expenditures are, all these kind of expenses are actually allowed in scientific. This is 100% allowed. Amount realized on transfer of assets used for scientific research is chargeable under PGBP. Why? Because already 100% is allowed. Okay, deduction allowed. So they have already taken the benefit of the scientific research. Now whatever amount they are getting is an additional amount. It's an income for them only. Whatever they are getting, already deduction allowed. While calculating the income or profit and loss. Now, whatever amount they are getting by transferring the assets they have acquired for scientific research, on transfer of the assets, whatever amount they are getting, it is chargeable under PGBP in the year of sale, lower of the deduction allowed under 35(1)(4) and the sale proceeds. So, whichever is lower, sale proceeds what the getting is lower, then that amount is allowed, and if the deduction they received under 35(1)(4) is less, that amount is allowed, without having been used for other purposes. There are two cases. One actually, it is not used for other purposes. Actually, from scientific research, actually it is directly sold. They are not used in business. Sale consideration to the extent of the cost of PGBP income. Excess over the original cost is taxable in the capital gain under section 45. So sale consideration to the extent of cost, just like we just considered, okay, just like balancing charge, up to cost it is PGBP, then above cost is capital gain under section 45. After being used for other purposes, sale consideration shall be subtracted from the relevant block of assets. In this case, at the time of conversion to normal business asset, the cost of acquisition shall be nil. There is no cost for the asset. When it is used, that asset purchased for the scientific research, when it is used in normal business, actually there is cost of acquisition is nil. Therefore, there is no depreciation allowed for that. Okay. Though there is no cost of acquisition, at the time of conversion. Sale consideration shall be subtracted from the relevant block of assets in this case. Now scientific research, during scientific research transfer to, while it is used in the scientific research, it is transferred to business. Then after completion of the use of scientific research, it is sold. So in the first case, which is transferred to business, cost of acquisition is nil. Then it is subsequently sold or transferred. The selling price income charged as per 41-1 towards recovery of deduction. Year of taxability is the year of transfer sale. The selling price is the income charged as per 41-1 towards recovery of deduction. Okay, whatever amount is actually deducted, that is actually charged under PGBP. Now sale proceeds, in the second case, PGBP income as per 41-3 is the lower of the deductions under scientific research or sale price in this case. So it is a PGBP income. Directly it is actually after use in scientific research it is sold, then it is a PGBP income directly. Section 41 clause 4. Any amount of bad debt recovered in full or in part for which allowed deduction under section 36(1)(7) in any previous year will be income under PGBP in the year received. So we have been allowed some deductions for bad debts. Okay, now we have written off maybe 1 lakh, and the assessing officer of income tax allowed only 60,000, and that 60,000 only will be considered as bad debts. So the PGBP income, and in subsequent year we may be recovering some amount. Okay, now we have recovered 30,000 rupees in subsequent year. Maybe after 3 years or 4 years, already it is allowed deduction for 60,000. 40,000 is disallowed. 30,000 was recovered after some years. Then the bad debt recovered. In that case, this 30,000 will be deducted from the disallowed amount 40,000, and 10,000 will be treated as disallowed amount, and there is no tax for that. Okay. Now more than that amount, disallowed amount is deducted, then the difference can be considered as income. PGBP income taxable is a bad debt recovered minus bad debt disallowed by AO. Now 40,000 in the present example, now 30,000 recovered, then bad debt disallowed by AO is 40,000, then it is actually 10,000 difference is there. Okay, so difference of bad debt claimed and allowed by AO is disallowed. Year of taxability is the year of recovery, where the deduction has been allowed in respect of bad debt and the bad debt is subsequently recovered, then the amount so recovered shall be deemed to be the income. When the deduction has been allowed in respect of bad debt and the bad debt is subsequently recovered. Now, okay, now actually 60,000, now the bad debt, 40,000 bad debt is recovered. For example, 1 lakh we have claimed, 60,000 allowed, 40,000 disallowed, then 40,000 recovered. That means actually there is no tax to be paid then, because actually the disallowed amount only deducted. After that, maybe after 1 year we have recovered 10,000 more. That means actually that 100% amount is allowed now. This 40,000 plus 60,000 already allowed. Now whatever we are getting is income. The 10,000 we are receiving again, that is an income under PGBP. where reduction has been allowed in respect of bad debt and bad debt is subsequently recovered, then the amount so recovered shall be deemed to be the income under the PGBP of the previous year in which the amount so recovered. Subsequent recovery. Okay. Now section 28 and 40, section 41 are there. Then gross business income here calculated. Then less deduction under section 30-37. Okay. Then the taxable income we calculated. Then subsequent recovery has come. Okay. This shall apply even if the business profession is no longer exists in the previous year in which recovery is made. Now let us consider an example. Rupees 1 lakh is recoverable from a debtor, Mr. A. The assessee writes off 40,000. Writes off 40,000 as bad debt in the previous year, 31/3/2019. Subsequently, in the previous year, 31/3/2025, 70,000 was recovered from Mr. A. Here, rupees 60,000 shall be deemed to have been recovered towards the debt and 10,000 towards the recovery of bad debts of 40,000. What it means is actually that only 40,000 is written off. 60,000 is not written off. Therefore, when 70,000 received, okay, 60,000 when 70,000 received, $60,000 is deemed to have been recovered because already 40,000 is written off. Then 60,000 is to be recovered. Therefore, out of the 70,000, 60,000 is recovered. Now balance 10,000 is there. Hence, this balance 10,000 will be treated as income in the previous year, 24-25, under PGBP. Already the 40,000 is written off and actually we have taken deduction on that. That is the reason why we are taking the 10,000 as an income. So 10,000 towards the recovery of bad debts of 40,000 and 10,000 will be treated as income in the previous year 24-25 under PGBP and taxable under section 41(4). So let us consider how it is accounted. Now A is a debtor actually. Now actually you can consider actually 1 lakh to sales. A is debtor. A debtor 1 lakh to sales 1 lakh. Then bad debt 40,000 to A. That is to be accounted in profit and loss also. Profit and loss account debtor 40,000 to bad debt 40,000. Now when we recover 70,000, bank debt 40,000, okay, to A 60,000 and to 10,000 is actually bad debt recovery. Now bad debt recovery debtor to P&L, that is also accounted in the P&L, and it is a profit income under PGBP. Now there are 2-3 case laws we will mention here. This one case law was actually PK Kaimal. Now as per this, the bad debt of the predecessor recovered by successor is not an income for the successor under PGBP. As per this verdict, the bad debt of the predecessor recovered by the successor is not an income for the successor under PGBP. Okay. Second case is actually Veerabhadra Rao. Second case. Second case is Veerabhadra Rao. One second. The bad debt was written off by predecessor and has shown as an income also in P&L. The successor can claim deduction. The bad debt was written off by the predecessor and the successor can claim the deduction even if not shown as an income by him. Whatever bad debt written off by predecessor since it's written off, successor can claim deduction, even if it is not shown an income by him. Now, another example, we can say actually bad debt 50,000, deduction allowed is 20,000 by the assessing officer, disallowed 30,000. Subsequent report is 40,000. Then taxable income is actually the 40,000 disallowed. From that 30,000 is recovered. Sorry, disallowed 30,000, recovered 40,000. That means the difference is 10,000. So the first the disallowed amount to be deducted and the balance is taxable under 41(3). Therefore, we received 40,000, disallowed 30,000, and the difference is 10,000. That is chargeable under PGBP under section 41(4). Now the recovered amount is only 20,000. Then since the disallowed is 30,000, 30,000 minus 20,000, 10,000 will be only, instead of 30,000, 10,000 will be disallowed, and there is no tax liability. Hence, 20,000 is allowed. Now, section 41(4)(a), amount withdrawn from a reserve created under section 36(1)(8). That is 41(4)(a). Anticipated losses, expenses. No deduction are allowed for anticipated losses. That is the reserve that you are saying, the amount withdrawn from the reserve created under section 36(1)(8). Anticipated losses and expenses. No deductions are allowed for anticipated losses. Example, provision for bad debt, doubtful debts. The provisions are not allowed. Okay. Capital expenditure are not allowed as deduction. Provisions are not allowed as deduction. Capital expenditures are not allowed as deduction, except specified business, except in the case of specified businesses. Expenditure on non-accessible business, not allowed. Example, expenditure for earning agricultural income is not allowed as deduction because the income is not accessible. Business expenditures must have been incurred by the assessee to get deduction. For get deduction, the business expenditure must have been incurred by assessee. Allowed for own business also if incurred even when the benefit is enjoyed by others. Okay, it is allowed for own business also. So there should be some business expenditure, then only it will get deduction. Notional expenditure. No one can earn income from himself or her son. For example, rent to sole proprietor or salary to proprietor is not allowed. Onus of proof lies with the assessee. So it is the responsibility of the assessee to give proof for the deductions. Rent from house property, taxable under house property under section 22, not under PGBP. However, if letting out house supports the smooth operation of the business incidental to business, then it is taxable under PGBP. Dividend on shares. Taxable under section 56(2)(1), income from other sources. Dividend from what shares are taxable under income from other sources, even if shares are stock in trade. The provision is not applicable to interest on securities held as stock in trade. Winning of lotteries and races. This is taxable under income from other sources. But when lottery tickets are treated as stock in trade, any winning from unsold ticket is a PGBP income. For example, there is a distributor, sole distributor, and the sub-distributors of lottery tickets. As far as the distributors are concerned, if they are getting some income out of the unsold ticket, they win some prize, that is considered as a PGBP income for the distributors. But as far as the customer is concerned, if they win some tickets, actually it is a income from other sources. But for a inventory, it is PGBP income. Exempted income. By virtue of section 10, death cum retirement gratuity, DCRG, and PF, HRA, all are exempted incomes. Some taxable under head capital gains for the purpose of section 28(5)(a) shall not be taxable under this head. So, the sums taxable under the head capital gains shall, for the purpose of section 28(5)(a) shall not be taxable under this head. Income from illegal business is taxable under PGBP. Specific deductions, section 30 to 43 dB, this is also chargeable under 430 dB under PGBP. Now, there are some income which are not chargeable under PGBP. The following incomes, though in the nature of profits and gains, business or profession, shall not be chargeable under PGBP. Rent from house property is taxable under section 22 under the head income from house property, even though the assessee is engaged in the business of letting out properties on rent, or such property is held in as stock and trade for builders who rent out completed buildings and all. For them also, it is house property, it is not PGBP income if it is inventory. Even if it is inventory for house property, even if it is inventory, it is a PGBP income. Sorry, it is not a PGBP income. It is income from house property. Not. However, where the letting out of house supports the smooth running of business, that incidental business, then such income can be treated as business income. Dividend on shares is taxable under income from other sources, even though the assessee deals in shares and such shares are held as stock in trade. The provision is not applicable in the case of interest on securities held as stock in trade. The shares, if you consider for investment, it is actually sale is capital gain and dividend is income from other sources. And if it is stock in trade, for sale it is PGBP and dividend it is income from other sources. So securities, debentures, bonds and all, the investment for investor it is sale is capital gain and interest is income from other sources. And for stock in trade, sale is capital gain and interest is income from other sources. Winning from lottery, races, etc. are taxable under the head income from the sources, even if such income is derived through regular business activity. Treatment of lottery tickets held as stock in trade. We are discussed the same point before also. Winning from unsold tickets held as stock in trade shall be treated as incidental to business and taxed under the head PGBP. Exempted income by virtue of 10, that is DCRG, then actually gratuity, PF, then HRA, all these are exempted. Some taxable under the head capital gains for the purpose of section 28(5)(a) shall not be taxable under PGBP. Example, profit on sale of route permit shall not be taxable under the head PGBP. Okay, and this 28(5)(a), let us see what this 28(5)(a) is. 28(5)(a) deals with 28(5)(a) non-compete fee. Okay, non-compete fee. So, non-compete for not carrying any business. So, it is actually PGBP income. But actually, that sum received for transfer of rights is a capital gain. So, some taxable under the head capital gains for the purpose of 28(5)(a). That means actually, if you are getting some income for selling of rights, that shall not be taxable under PGBP. So that here actually another one example given is profit on sale of route permit. It's for some rights they are transferring. It is not taxable under the PGBP, it is taxable under the gain, capital gain. Now with this we have completed the chargeability section, chargeability portion for the PGBP. Okay. Now let us go for other sections from section 30 onwards. Okay. Other sections of the PGBP we will discuss in the next class, the part 2 of PGBP. Thank you very much.